Today, we're really getting into something critical for swing traders, something that happens after you've entered a trade. How do you actually manage that position? How do you ride a winner for big gains without jumping out too early, or maybe worse, watching all those profits just vanish? It's a tough balance.
Oh, absolutely. It's probably the central challenge after the entry. Getting in is one thing, but getting out right.
Yep.
That's often where the real money is made or lost.
Yeah.
That pain point you mentioned, seeing profits evaporate. Yeah, every trader feels that.
Exactly. And that's why we're focusing today on a tool we see as, well, pretty fundamental, the trailing stop loss. So just to start, what exactly is a trailing stop loss, and why is it such a key part of the puzzle for trading successfully?
Think of it like a dynamic shield, maybe a safety net that moves with your trade.
Yeah.
So unlike your standard stop loss, which just sits there at one price.
Right, the fixed one.
Yeah, exactly. The trailing stop adjusts. If you're in a long trade and the price goes up, your stop loss level automatically moves up too. And this is really crucial because it gives your winning trade room to breathe,
Yeah.
Lets it keep going as long as the momentum is there. But at the same time, it's building this rising floor underneath, protecting your profits.
Okay, so it's about finding that sweet spot then, letting profits run, but also having that protection in place. How does it manage that balance effectively?
Well, it locks in profits as you go, but crucially, it doesn't put a cap on your potential upside. Imagine you buy something, it starts moving up strongly, your trailing stop keeps moving up behind it, maybe a certain percentage or based on volatility. We'll get into the types later.
Okay.
So if the trend does eventually turn around, bam, the stop gets hit and you're out with profit secured. You haven't cut the winner short with some arbitrary fixed target you set way too low.
Right, that makes a lot of sense. Instead of just aiming for, say, a 10% gain, you're saying, let's see how far this can actually go, which could lead to much bigger wins. Those exceptional risk-reward ratios traders are always chasing.
Precisely. You hear about 2.1, 3.1 reward to risk all the time. And those are good. But a well-managed trailing stop, especially in a strong trend, it can blow those numbers away. We're talking 5.1, 10.1, sometimes higher in the right conditions.
And what about sudden shocks? Markets can turn on a dime, right? Unexpected news hits.
Yeah, and that's another huge benefit. It's like an automatic defense system. If some unforeseen event slams the market and causes a sharp reversal, your trailing stop is already there, guarding the profits you've built up. You don't have to be glued to the screen or react in panic. The order is working for you, making sure you don't get caught flat-footed watching gains disappear in minutes.
That touches on the emotional side too, doesn't it? The fear of losing profits making you exit too soon, or that hope keeping you in a losing trade. How does the trailing stop help manage those very human reactions?
It's a massive help for discipline. By setting a clear, objective level for taking profits or cutting losses on a winning trade that reverses, it really cuts down on the emotional second-guessing.
Takes the guesswork out.
Yeah, largely. You're not constantly agonizing, is now the time? Should I wait a bit longer? The trailing stop is a predefined rule. It fosters discipline, stops you from making those impulsive, fear, or greed-driven moves that wreck so many trading accounts.
Okay, so most platforms offer automated trailing stop orders. Just set it and forget it. Is that generally the way to go for swing traders?
It's convenient for sure. But our perspective, especially at AccumulationPro, is that a more, let's say, considered approach, often involving manual confirmation, can actually be better for swing trading.
Oh, interesting. So not just setting the automated order. Why is that?
Well, we put a lot of emphasis on confirming a real break of that trailing stop level. And we find it really valuable to watch the price action in, say, the last 30 minutes of the main trading session.
The end of the day.
Exactly. That helps filter out the intraday noise.
Yeah.
Those quick dips below your stop level, that might just be temporary volatility or even attempts to shake traders out, fake outs, basically.
Stop hunting.
Could be. By waiting for that end-of-day confirmation, you get a much stronger signal about whether the break is genuine, whether momentum is actually fading.
So you're trying to avoid getting whipsawed out by just noise during the day.
That's the idea. Look, a trailing stop loss isn't just some random price. It should be a meaningful level. When it breaks decisively, especially near the close, it's telling you something important, that the bullish momentum you rode is likely running out of steam. Ignoring that signal, just hoping it bounces back. That can turn a great trade into a mediocre one, or even a loss. It's about protecting capital and moving on to find the next opportunity.
It sounds much more adaptable than just picking a fixed profit target and hoping the price gets there.
Oh, absolutely. Fixed targets, by definition, limit your upside. If a stock is in a really strong trend, why cap your gains? Trailing stops let you ride that wave, potentially capturing much, much larger profits.
And you mentioned risk management earlier. How does it fit in there beyond just locking in profit?
Well, think about it. As the trade moves in your favor and the trailing stop moves up, the distance between your entry price and your stop price shrinks, or rather the stop moves above your entry.
Right, so your initial risk disappears and then you're locking in profit.
Exactly. You're actively reducing the potential loss on that trade and then guaranteeing a profit. So even if there's a sharp reversal after a good run, you're likely exiting with gains, minimizing drawdown on your account. That disciplined risk reduction also frees up mental capital, stops you getting too emotionally attached to one position, and frees up actual capital for new trades.
Yeah.
It's fundamental.
Okay, principles and benefits are clear. Let's get practical. What are the different types of trailing stops? You mentioned fixed percentage first. How does that one work?
Yeah, that's probably the most common one you'll see offered by brokers. It's simple. You set the stop loss a fixed percentage below the highest price the stock has reached since you got in.
Sounds straightforward, but you hinted it might not be the best. What are the problems?
The main issue is that, well, different stocks have vastly different personalities, right? Different volatility.
Sure. Some are sleepy, some jump around a lot.
Exactly. So a fixed 5% might be way too tight for a volatile stock. You get stopped out constantly on normal swings, those whipsaws. But for a low volatility stock, 5% might be too wide, not protecting you enough when it finally does turn. Plus the percentage itself, It's often kind of arbitrary. Is 5% meaningful or 8%? It might not line up with any actual support level on the chart.
So a break might not mean much technically.
It might just mean it wiggled down 5%. And because it's so common and predictable, some argue it's easier for market makers or algorithms to potentially target those known fixed percentage levels.
Okay, so if fixed percentages are maybe a bit too rigid or arbitrary, what's a more price action aware approach? You mentioned candlestick patterns.
Yes, this brings actual price behavior into the equation. When you're in an uptrend, you might see certain bearish reversal candlestick patterns, forming like a shooting star, or maybe a bearish engulfing candle.
Signals that the buyers might be losing control.
Potentially, yeah. They suggest momentum might be weakening. So with this method, you'd place your trailing stop based on that pattern. For instance, you could put it just below the low of that shooting star candle.
Makes sense, using the pattern itself.
And again, linking back to what we said earlier, you'd ideally wait for a confirmed close below that level, maybe in the last half hour of trading, before acting on it. It requires understanding candles, of course, but it ties your stop to what the price is actually doing.
And what about bigger picture patterns, like chart formations? Similar idea, but on a larger scale. Reversal chart formations, like double tops or the classic head and shoulders pattern, can signal a potential major trend change.
Right, those textbook patterns.
Yeah. So if you're long and a head and shoulders top seems to be forming, you might place your trailing stop below the neckline, that key support level. Or if the market's really choppy, you might even tighten the stop earlier, maybe after the right shoulder forms, as that's often where selling pressure increases. Breaching key levels of these larger patterns often signifies a more substantial shift in supply and demand, making them pretty meaningful exit signals.
Okay, now you also mentioned ATR-based stops. That sounds more quantitative.
It is. ATR stands for average true range. It's a measure of volatility, basically, how much an asset typically moves over a certain period.
Okay.
So an ATR-based trailing stop uses this measure. You might, for example, set your stop 2 times the ATR value below the current closing price. The key thing is, as volatility increases, the ATR value gets bigger, so your stop automatically moves further away from the price, giving the trade more room. So it adapts to the market's choppiness.
Exactly. And if volatility decreases, the ATR shrinks, and your stop tightens up closer to the price, locking in profits more aggressively. This adaptability is, we think at AccumulationPro, a huge advantage over fixed percentage stops. It respects the market's current conditions.
That dynamic adjustment sounds really powerful. What about using recent lows? That seems simpler.
It is simpler, yeah, and very direct. It just looks at recent price action. A common tactic is to place your trailing stop just below, say, the lowest point of the last 2 or 3 of those lows.
What's the logic there?
The logic is that those lows were points where buyers stepped in before. If the price now breaks below those levels, it suggests that previous support is failing and the upward momentum might be breaking down. It anchors your stop to recent demonstrated levels of buying interest.
Makes sense. Okay, moving on to oscillators like RSI. How can they fit into managing exits? They're more about momentum, right?
They are, yeah. Oscillators, like the Relative Strength Index, RSI, help identify overbought or oversold conditions. So in a long trade, you might watch for the RSI to get into overbought territory, usually above 70, but more specifically, you might look for signs of weakness within that overbought condition.
Like what?
Well, maybe an overbought failure where RSI goes above 70, then dips back below it, or a bearish divergence price makes a new high, but RSI makes a lower high.
Okay, subtle signs of weakening momentum.
Exactly. These signals, especially if they line up with maybe a bearish candle pattern or a chart formation starting, could be an early warning that the trend is getting tired. It might prompt you to take some or all profits, or at least tighten your trailing stop considerably.
But you need confirmation.
Definitely. Oscillators can give false signals, so using them in conjunction with price action analysis is crucial. But we at AccumulationPro do find non-lagging oscillators useful as potential early warning flags for momentum exhaustion.
Got it. Lastly, you mentioned Heikin-Ashi charts, which is interesting because you also said you don't recommend them for actual trading or backtesting. How does that work?
Yeah, it sounds a bit contradictory, doesn't it? Heikin-Ashi charts average the price data to create smoother-looking candles. This averaging makes them great for visualizing the trend and momentum.
Filters out noise?
It does, makes the trend look cleaner. But that same averaging means the highs and lows on a Heikin-Ashi chart don't represent the actual highs and lows the price reached. So for precise entries or backtesting, they're not ideal.
Okay. So how do you use them for trailing stops then?
You use their strength identifying momentum shifts. In an uptrend on Heikin-Ashi, you'd look for when a candle makes a new low compared to the previous Heikin-Ashi candle. You would then place your potential trailing stop level just below that Heikin-Ashi low.
But you don't exit based on the Heikin-Ashi chart itself.
No, that's the key. The exit trigger is still based on the real price. You only consider exiting if the actual closing price on your normal candlestick chart breaks below the level you identified using the Heikin-Ashi low.
Ah, okay. So Heikin-Ashi helps identify a potential important level based on smooth momentum, but the real price action confirms the break.
Exactly. It uses the clarity of Heikin-Ashi for momentum signals, but relies on real price for the actual execution trigger. It's a less common technique, but it can be quite effective at filtering noise while still responding to genuine shifts in underlying momentum.
Wow, that's a really comprehensive look at different trailing stop methods. It's crystal clear that getting this exit part right is just, well, essential for swing traders looking for consistent profits.
It really is. Understanding these different types, knowing their pros and cons, and then applying them with discipline that can make a huge difference to your bottom line and your risk management.
And for listeners who want to explore these kinds of strategies further, especially maybe the more advanced or algorithmic approaches,
well, we definitely encourage you to visit AccumulationPro.com. You can learn more about our approach there. We focus heavily on algorithmic strategies designed to identify high probability setups, often by understanding how smart money might be positioning itself. And of course, sophisticated risk management, including advanced trailing stop methods, is a core part of that.
Because ultimately, that risk management is the foundation, isn't it, for staying in the game long term?
Absolutely non-negotiable for long-term success.
All right, so a final thought for everyone listening. Think about how actively adapting your exit strategy, moving beyond simple fixed targets, and aligning it with a smarter analysis of market momentum, perhaps even considering how the bigger players operate. How could that fundamentally change your trading results? Thanks for joining us for this deep dive.